Hello, viewers. Welcome to this episode of the Investor's Wisdom Nuggets. Last time we talked about the investment philosophy. We also talked about using the price earnings ratio as a quick way of identifying cheap shares. Now that we have used the PE ratio and we have 5 possible shares that we can buy, what else should we consider to select the best share? I have 3 other criteria that I will usually use. Number 1, I will look at the shareholding structure. Number 2, I will look at the quality of earnings. Number 3, I would also look at the dividend policy of the organization. Shareholding structure. Why are we worried about the shareholding structure? We want to know who holds the shares, who holds the majority shares. How financially robust are they themselves? Because usually in times of financial trouble, like in pandemics like this COVID pandemic, companies will always run back to their shareholders, ask for additional funding so that they can cover gaps and possibly go to investors when they've identified opportunities which actually need a quick reaction. Opportunities where management should move with speed to take advantage of mispricings of assets. So we always want to invest in organizations who have strong institutional investors. Institutional investors will also help us to monitor the activities of management. Remember, there is what we call the agents problem, where those managers are, there is always a temptation for them not to act in the best interest of shareholders. And the more the level of shareholder dispersion, like if an organization's shares are held by retail traders only, it's so difficult to monitor because obviously most of the retail traders, they do not have technical information. They cannot question decisions. So institutional investors will help us. We can actually free ride on them. We don't necessarily need to incur anything ourselves. If we are minority shareholders, we could be rest assured our interests will be taken care of by the institutional investors. So organizations with strong institutional investors are more preferable to those with a high level of shareholder dispersion amongst individuals, tiny minority investors. Secondly, I would be worried about the quality of income. When I talk about the quality of income, I want to understand, is it recurring? To what extent can this profitability that I have seen in this year's financial statements be replicated? Because remember, when we are buying those shares, we are buying our pension portfolios. We want growth. We want sustainability. We want continuity in terms of profitability. So we would be interested in buying into companies which are generating income from their ordinary trading activities. We don't want to be tricked by once-off transactions, what I may call noisy transactions. Let me put it this way. Some organizations will operate the whole year, 11 months, earning an operating loss. And what do they do towards the reporting period? They may decide to revalue assets, number 1. Number 2, they may decide to borrow from the bank. Number 3, they may decide to dispose of assets at a profit and earn a profit on disposal. This profit will always appear in this current year and is likely to mislead those people who will be using relying on the accounts to make a decision. So we need to look clearly, look soberly, identify all those kind of transactions, pull them out, and actually understand how much profit was generated from operating activities. Because an organization which cannot generate profit from its ordinary activities is not a sustainable organization. Number 3, the dividend payout ratios or the dividend policy. There is some information which managers cannot communicate directly to the market, But this information, we can read it from the dividend policy. Dividends have what we call the informational content aspect of dividends. They convey certain information. For example, from a young organization which is still experiencing growth, I will be worried if they pay huge amounts of earnings as dividends. Why? Because I expect those earnings to be reinvested to generate further value for shareholders. So if managers are paying dividends when we actually anticipate growth, what are they saying? They are basically telling us, guys, we are very sorry, we are unable to identify profitable opportunities to invest your money. Opportunities which would earn a return which equals to or surpass what is being earned currently on investments that they have made. Secondly, a mature organization would always pay a dividend if the managers are certain that this dividend level is sustainable. We will be able to continuously pay this level of dividend every year. So, for example, if you are looking at the London Stock Exchange, for example, counters like Barclays Bank, I would be excited if they are paying a dividend. On the Zimbabwe Stock Exchange, I'm looking at counters like the Old Mutuals, the Deltas, the Econet, the AFDIS, all those other big organizations. If they are paying a dividend, I would be excited. I would consider that to be an endorsement of a bright future. So these three, they are quite important. Thank you so much for your time. Kindly subscribe to my channel if you haven't done so already. Share this channel with colleagues. If you have any issues or topics that you think I should talk about at depth, don't hesitate to alert me. Thank you so much for your time. Till we meet again next time. Bye.